Thank you for joining us today. My name is Bill Baker with Firestorm, and we're pleased to have you joining us today for this webinar. This is part of the Crisis Coach webinar series presented in conjunction and supported and hosted by the Rochester Business Alliance. Today we're going to be discussing the value of internal auditing. This is the fourth in the series so far this year. We invite you to become our Facebook friend, Firestorm Solutions on Facebook. You can follow us on Twitter. Firestorm Soul is the Twitter address. And yes, there is a hashtag, and that hashtag is Crisis Coach. Firestorm transforms crisis into value and empowers you to manage risk and crises. Firestorm expertise is crisis management, critical decision support, crisis communications, crisis public relations, and consequence management. Please keep in mind that the presentation today is not complete without the accompanying oral comments and discussion, and the work product presented must be considered in conjunction with your organization's personal counsel. In addition, this information and comments made should not be interpreted as legal advice or legal opinion. The Rochester Business Alliance and the Association of Contingency Planners, Eastern Great Lakes Chapter, are the hosts and co-sponsors of this webinar series. Chip, over to you, please.
Well, thank you, Bill, and good morning, everyone. I'm delighted to welcome you to the fourth in the 2015 series of the Crisis Coach. The Rochester Business Alliance is pleased to continue our partnership with Firestorm and our friends at the Eastern Great Lakes Association of Contingency Planners to bring you, our members, this important 45-minute discussion by Jim Satterfield, one of the country's top crisis managers, covering the value of internal auditing to identify specific crisis risk exposures in your business. Teaming with Jim today is Jack Healy, an operational and financial expert and a graduate of the Syracuse Whitman School of Management. So we always get a tie into the Rochester area with most of the things that we do with Firestorm. Today I admit that my mind is on the fatal flight of Germanwings Flight 9525 into the French Alps with 150 souls on board, and how one young man proved to be the most critical risk exposure Lufthansa will ever face. This time, the risk was a series of medical issues, eyes, depression, bipolar disorder, suicidal tendencies that were mostly hidden from his employer. But as Jim has told us many times, there's always a tell before a disaster. And I'm quoting, "One day, I'm going to do something that will change the whole system, and everyone will know my name and remember." End of quote. Andreas Lubitz told his former girlfriend, a flight attendant. If someone made such a comment to an associate in your organization, would your information network pick it up? Let's hope so. That's what Jim and Jack will help you figure out in the next 45 minutes, and then I hope that you will never have to go through an event such as the one with which the Lufthansa management team is struggling. Now here's Jim.
Chip, always a great lead-in and insight. I really appreciate the time that you spend and think on these topics, and I think you're correct. There's just a lot today to think about. And Chip's out in Tulsa this morning. He didn't share that at the beginning, and the tornadoes that had just come through there a couple of weeks ago. So we all face exposures everywhere, and we're glad to be with you today. So Jack and I are going to talk about these things, and I think you'll have some new insights to consider it. And the challenge that is in front of us all is, can we identify our next crisis? It's important that you think that way and look that way, and as we go through, I think today you're going to see some approaches that are a little different than what you've considered in the past. When we think about the internal audit role, all of us are today facing an expectation of management of risk. If you're in a regulated industry, that's what every regulator is looking toward. If you if you have employees, they're looking to keep their job and have those paychecks come in, and your customers are looking for their products and services, and your investors are looking for a return on that investment. And so as we come together today, the expectation of management of risk is a central requirement in every business. So as we think about the role of internal audit, it's to assure to provide assurance for the board and management. And if you look at the steps that are listed down below, it's fairly consistent with what you see internal auditors focusing on. Now, your company may be large with a full internal audit department. It may be small, and that function isn't a defined departmental exposure. But it still means that those types of things need to be addressed. To look at the risk management process. Have you correctly identified those risks? Do you have keys on how you report that information? The example that Chip gave us this morning of any piece of information could be that tell, could be that indicator that there's an exposure out there. You want to review on how you handle those risks associated with it and establish a set of controls to deal with them. And the continual requirement to oversee the monitoring, to have your own intelligence network. And we've talked about that in previous webinars, and we'll only briefly touch on it today. But of the 5 common failures in a disaster or crisis, the third is failure to identify and monitor all threats and risks. So as you look at that, now it says we do need to take a look at these types of things. Why do we want to measure this? We really want to determine, can we survive these types of events? And we want to know where we are today and what kind of progress we're making in these areas and what are our priorities and gaps. And we also look back at supply chain failure and are our suppliers prepared as we come into it. The other thing that as we focus on it is you've got to figure out where you're going. If you know the starting point, and that's one piece of it. If you know where you're trying to get to, we then can measure that distance and start to carry forward. We've seen a lot of exposure in the recent weeks and months around cyber breach, and the FBI director has stated there are 2 types of companies, those that know that they've had a cyber breach and those that have had the cyber breach and don't know it. As we look at it, whatever the exposure, whatever the risk, we need to be able to establish where we are and where we're trying to go. So what should you measure? You've got to measure what your goals are. We were talking with a firm the other day around some OSHA and environmental health and safeties and exposures, and they were looking for training around those elements. And the key is on training, you want to train to your plan. And if the plan's not right, then that means you're just further enhancing the potential of failure associated with it. So to identify your goals, look where you're going, and then make sure that you're following best practices in each one of the key areas there. Now, how should you measure? You've got to measure the plan content, the test results, the requirements that are there. We can focus on our people, we can focus on our IT, we can focus on our facility and in every aspect associated with it. What's the return on investment within the planning area? Or in some cases, what's the return on no investment? Many times if you don't put these things in place, it's going to make the problems even more significant. So as you've heard us talk in these sessions, we follow a predict, plan, perform process. Predicting what the vulnerabilities and threats are, their impacts, how we monitor them, the triggers. The plans cover everything from people to communicable illness to recovery. They also cover security. Excuse me, that sneeze was brought to you by the pollen in Atlanta today. And then finally performing, the training, the exercising, the supplies, the materials, the monitoring, and the other elements. So as we come through this, there's a lot of things for us to consider. So Jack, what's the difference between risk and crisis?
Well, thanks, Jim. And, you know, when we're talking about internal audit and whether or not your company has internal audit, larger companies will have internal audit, but most companies have a controller. All companies have senior leadership. All senior leadership in every company almost will take on a role of internal audit and looking at what's out there and what you need to be concerned about. And so there have been a number of organizations that have tried to quantify what risk is and how it relates to crisis. And you'll see on the slide I referred to COSA, which is the Committee on Sponsoring Organizations, which is the AICPA, some very large companies like IBM and some of the top companies in the world got together to come up with a framework, and they developed this framework about 35 years ago, and actually just recently updated it again. And so COSO is a group that takes a look at risk and tries to look at the likelihood and impact of an event on your company. Now, ISO has also modified their protocols this year, and they now want companies also to look at risk. And they've built in and they've defined it as an unwanted outcome. But these two organizations are the bedrock and framework for which all companies should follow, and it's very easy to go online. All their materials are accessible and are free. And what they're trying to promote is a good risk culture. Of course, a crisis is something that happens that's really bad, requires your immediate attention, and is something that could be a turning point for your company, but in any event, it takes you away from doing your day-to-day operations to deal with this one crisis. And we've spent a lot of time trying to study what this means. And we've done that with, in terms of phrase, business crisis risk. And business crisis risk is more than where companies today have been planning for business continuity. They tend to focus on the external risk. Business crisis risk is the risk that's embedded in your organization. And it can be structural, it can be operational, or it can be functional in its processes. Now, structural design is really how you communicate. Is your board effective? Is the board just a good old boy club that's hired by the CEO to rubber stamp everything? Or do they understand their role of oversight? Or is your board too intrusive and actually tries to manage the company? Very hard to have the right mix between management and board. Structural can also be in how you communicate through the organization. Does the CEO keep everything close to the vest? Or is it a functional base where the leadership team gets together and hashes out problems? If one member of the organization sees a problem, will they pick up the phone and call another one? I had a procurement manager when I was CFO of a public company, and he would be out at a site. We were constantly out in the field. If he saw something in a warehouse that affected accounting and the inventory, he would call me up and say, hey, Jack, have you been out here? Have you taken a look at this problem? Operational control is really how a company will have its operational processes. You know, the easiest one is quality assurance. You know, do they have a good quality assurance program whereby they check the containers when they come in, that they have specs that they're measuring to, that they know that this product is supposed to have 8 holes and not 6. Once, when I first became CFO of this public company, we rolled up 9 individual companies. We put them public, took them public the next day in the New York Stock Exchange. Well, I had some lingering litigation where one of our companies we bought burned down $1 billion textile plant. And the cause of that was that one of our products literally had 3 holes in a coupler where it was supposed to have 4, and that coupler failed, and due to a series of cascading calamities actually resulted in burning that plant down. And that all came back to quality assurance. Or functional basis, and functional, think of that as your silos. Does Treasury do what they do? If the treasurer is going to be out or the controller is going to be out on payday, do they have a backup system that somebody will fund payroll so that your employees get their checks? Or, you know, does the sales team have good quality, good controls over what a gratuity they can accept so there's no graft? So functional is the silo. So we've taken a look at that, and no matter how you look at risk, in the end, when something goes wrong in a company, it either impacts the people, profitability, or your reputation and brand. And usually, it always impacts reputation and brand. The question is, what's the severity of that? So we tried to take a look at this from a business crisis risk, and as we've taken a look at it, we've been able to identify certain things, and this is important. And the study of business crisis risk is important, and if you could flip to the next slide, Jim. It's important because it helps you find the unforeseen problems in your business before they happen. And the way you do that is exactly what Chip was talking about with indicators. You know, see something, say something. And sometimes these are very, very subtle. And as we did the research behind business crisis risk, I called upon my fraud training quite a bit. And as a certified fraud examiner, you never actually see fraud. You only see the indicators of fraud. You see the fact that the controller or accountant doesn't take a vacation, or in one of the Superman movies, Richard Pryor was the accountant that stole a tenth of a cent from every payroll check, and the only way they caught him is he was doing donuts in the parking lot in his brand new Ferrari. The brand new Ferrari for this low-level accountant was an indicator that they had a problem. Well, we do that in crisis risk as well. We look at those little things that aren't working right in your business. And as we've gone through this, we were able to determine that there's a pattern behind it. Now, taking a look at this also empowers management to avoid or mitigate the risk. Usually when you've seen it, the crisis is already beginning. If you catch it in the early, it doesn't become, it's a problem. It's a business problem. Now, business crisis risk, if there are accountants that listen to this, they'll go, well, we already do that. That's enterprise risk management. We go through that. Our auditors bring us through this. We have a code framework, which is enterprise risk management. ISO is also a form of that. They have you build quality procedures. But they tend to focus on the things that are predictable. They tend to focus on what could have impact, and then when they come up with a solution, the solutions tend to be very broad and general. For instance, when I would be an external 16 years in an accounting firm, and I'd go into a client and I'd say, you have a risk of 30% of your business. And what would you do if you lost that customer? And they would write a paragraph and say, well, if we lost this customer, we will go out and we will find other customers, and we'll also cut our overhead and we'll downsize to mitigate that risk. Well, that doesn't address what other types of risks are out there. It doesn't address the risk where the CEO gets caught having an affair. You know, HP, if you remember, they had a turnover in one of their CEOs. He wasn't on the job. I think he was on the job 2 weeks when it came about that he had had a relationship. Lockheed nominated a CEO who never took the job because after his nomination it came out that he had an inappropriate relationship. Well, when we talk about these risks, we don't talk about the detailed plans behind it. So in my example of the large customer, in business crisis risk, you actually walk management through the process of what will you downsize? Who will you downsize? I call it the parking lot test. Will there be fewer cars in the parking lot? A lot of times when I go in a turnaround situation as a business advisor, people will say, yes, we took 3 FTEs out of our organization, and you take a look at it, it tends to be the lowest level person, and then they take their responsibilities and they just pile the work onto somebody else. It has very little impact on the business. They feel good because they said they took out FTEs, but it really doesn't help the business. Business crisis risk, we actually look at the detailed plans, and look at what you're going to do to help with the operational execution risk, what you're going to do to mitigate your plan, and it includes everybody in the organization. It's a cross-functional team. So it takes a look at the board, the senior executives, those are frontline managers. And business crisis risk identifies all the possibilities that you could have that would cause problems to your organization. Now, can you really predict it? And to get back to the warning signs, and yes, we can. And the reason why we can is because we're going to train our organization to look for these signs. And then we're going to have a process by which that we can follow to address those concerns. So as you go through this process and you train your organization to think like this, you'll find that the framework that we're outlining works for any crisis, whether it's data breach, the legal acts, poor quality assurance, loss of a customer, or I had a client and their problem was being able to fulfill demand. And they were a gun manufacturer, and they were in upstate New York. And this gun manufacturer hired us to go out and find alternative sources of supply and mitigate this risk. Well, in the middle of it, their largest banking group said, we don't want to fund firearm manufacturers anymore. And then their largest investors, the pension plans, came out and said, we don't want to invest in these anymore. And this was, of course, after the tragedy of Sandy Hook. So there's large billion-dollar employer of 1,500 people, all of a sudden found they had high demand on one end and no money and no investors on the other, and how do you mitigate that risk? So I want to just remind you of the 5 steps that you go through in any crisis. So there's the pre-action, the onset, the impact, response, recovery, and consequence management. Now, Jim always puts this up to prove that he designed this, and through his Georgia Tech background, you always have something that's very complicated that nobody will understand. And I'm just, a simple accountant from Syracuse, and actually still on the Lubin School of Accountancy Advisory Board. So I can only break this down into 4 blocks. And so when we were developing the business crisis risk model, we came down to the 4 blocks that make this up, which is acute business crisis, severe, difficult, and chronic. If you look at the axis on this for the predictive diagnostic model, this is how a company will deal with risk in different levels of risk. So at the top, you see on the vertical axis, there's extreme urgency. At the bottom, it's reactive and urgent. So one is, I've got to deal with it right now. I have to drop everything I'm doing. It's all-consuming. The other is, I better deal with it now, but I can also multitask and do some other things. On the horizontal axis, you'll see that they're targeting to the left or complex. Targeted, it is very identifiable. It tends to be a single item. That single item can cascade out of control, but it's a single item. The right-hand side, they're complex. It's going to touch several functional areas, or it's going to require operational and structural mitigation, so it's more complex. So let's take a look at these a little more closely. In the upper left-hand corner, when you look at the acute business crisis, this is where business continuity planning is focused today. These are the type of things that you've trained for. It's the overwhelming event, is a lot of confusion, so it's the fire, the tornado, plane crash. It's the event that happened to Lufthansa. Now, Lufthansa is more complex, as we'll see as you look at some of the indicators that were out there. The event is a plane crash. The causation of it was that we had a failed HR policy, a failed policy to monitor whether or not pilots are fit to fly. And there could also be some regulatory failure, whether or not in Germany, and we actually have it in the U.S., does a doctor have the right to go to an employer and say, your employee is unsafe? So as you look at these events, they're all consuming, and it happens right away. But we also have a lot of plans that deal with these. Airlines absolutely have a disaster recovery plan for a plane going down. It's very predictable. In the South here, we have plans that deal with tornadoes. And actually, I had to use one of those plans when a tornado hit our factory at our distribution center at 4 in the morning on a Friday. So I had plans. The good news is it happened at 4 in the morning on a Friday. It happened in a town where the textile industry had been gutted, so there was a lot of extra space around. Not ideal for distribution, but we could move. And we actually had a plan that we mitigated, and we were up and shipping at about 60% level the next morning. We also found, and we'll talk later on about hot washes, we also found we had some flaws in our plan. Our plan was always we'll ship product from other distribution centers to our customers, only to find out that the product subsets in these distribution centers are totally different. And we've actually used that with other clients. So the acute business crisis is the one we're all focused on. Now, if you go down some, you'll see that the next level is the difficult. And this is the day-to-day stuff that everybody on this call deals with. This is our lease is coming up for renewal, and we have to go out and find a new space. It's that kind of event, but some of them are a result of poor policy. So I had many small clients that would have a holding company and have many subsidiaries underneath them, and they would have different HR policies and benefit policies for these companies. Now, by law, if you have a benefit for a sister organization, it actually has to mirror the benefits of the other organizations. You can't give somebody a better benefit if they're all under the same umbrella. Some businesses, they'll give, Susie a payday advance, but because she's been here with me for 13 years, they won't give Joe a payday advance because they know that Joe has been, with the company only a couple of years, and he's not that reliable of an employee. But they don't have a consistent policy. They treat one person different than the other. They have the poor sales cutoff. How many of you have run through the exercise at year end where you put blue tape in the part of your manufacturing plant or distribution center, and you say these items have been sold? They're in. They've already been shipped. We're just waiting for the shipper. We're going to include these as shipped. And then the freight company doesn't show up till the next morning, but yet you're still going to include them as last year's sales. Or the contract, if you're in the service industry, I was in an accounting firm, and we were cash-based, and there was a big push to go and collect your receivables, and so we would be doing some planning, and the question would be, are you going to go to the mailbox on December 30th, or are you just going to let the money sit in the mailbox for the next couple of days? Poor cutoff, poor procedures, expense reports that really don't tie down, that nobody's really looking at. So it's kind of poor policies, it's poor processes. It gives rise to a problem, and then you deal with that problem and you move on. You never realize that it's an underlying policy. You deal with the problem as it goes on. So it's targeted in that it's one item and it's reactive. So as these problems begin to build, you move into the next quadrant, and the next quadrant is the chronic business crisis, and that's where the proliferation of poor policies and poor procedures really begin to pile up. It's really a lack of management, and it can be from the CEO, it can be from the CIO. We've seen problems with companies now where they're looking at breaches, data breaches, only to find out that the CIO knew that they had a problem and never effectively communicated it to other people. These are the long-term systematic failures, and it usually is because nobody is measuring that we've got a problem. Now, an example here is I got called into a company, and we were asked to take a look at whether or not, what the problem was with their inventory. They had all this inventory building up, and they didn't understand, and the bank was complaining that the inventory was non-conforming. Well, as we got in there, we started to peel back the onion, and we found out it was a quality assurance problem, and it had to do with bad procurement policies. They were not giving their suppliers enough detail on what their product should look like. The product would come in, they wouldn't even look at it. It was a online business. They actually would ship it out to their customers, and it was their customers that were finding the problem. As we went through this, we started mapping it out. We found out that customer service was telling them, hey, we're getting these products back. So, and then they would put them back in the warehouse, and to make it worse, if it just needed a part, they'd pull the part off a good product and ship it out. Well, it had an inventory problem that the bank wasn't lending on that led to a liquidity problem. The underlying issue is quality assurance. So that example shows you how it would touch multiple areas of a business. And this is where I find managers and management saying if not for, we would have. Now, our government does that. We had a poor GDP in the first quarter, and they blamed it on the weather. Now, if you go back, we had poor GDP in the first quarter of last year, and because it was down over the fourth quarter, and they blamed it on the weather then too. So when I was in an auditing firm in the South, if you get a little bit of snow, everything shuts down. Well, we would be behind schedule because one of our clients would shut down for 2 days. Well, I was in May. It was in May, and we were having a management meeting. We were asking why we were behind on a certain project, and they actually went back all the way to the snowstorm in January and said, this is our problem. I had another client that couldn't get a loan for his business, for his commercial business, and he was a sole tenant and a sole practitioner, and he was 65 years old. And he came to me and he says, well, I can't get a loan because of Dodd-Frank. Well, no, you can't get a loan because you haven't gotten another tenant in the building that's not 65 years old, because if I'm a bank, I'm not signing a 15-year lease with a guy that's 65 years old. And tried to tell him that you didn't manage your business, and this is what the problem is. So management, a lot of times, they start making the excuses, and in the business continuity world, we call that disaster denial. Well, this is business crisis risk denial. And the way you start to see these things come about, it's the whistleblower, it's the FCPA violation, data breach event. The example I gave with the CISO, or the company didn't have a CISO, they had a CIO who who had a problem and they didn't realize they had one. And you can see the other one. And then these begin to boil and bubble into the last phase, and this is the death spiral of a business. This is where you've lost control of your business. This is where people come in and they start taking over your business. It's either the banks, it could be investors, it could be regulators, it could be competitors. Competitors will see how dysfunctional you are, and they'll just start taking your business away from you. And this is the indicators there. There's a total lack of communication within the business. The bunker mentality has really set in, and that there's not much that you can do at this point, except there have been a number of examples out there. There was two banks merged back in the 90s, early 2000s, Wachovia Bank and First Union. First Union Bank was actually the acquirer of Wachovia. First Union had destroyed their brand so badly that when they bought Wachovia, they changed their name to Wachovia. They actually bought the company for brand awareness. Darden Foods, that has Olive Garden, they had a dissident group of shareholders that actually delivered a 300-page report to Darden Foods that told them of all the operational and functional inefficiencies in their business, all the things that were going wrong, and the board completely ignored them. And what they do, they went in and they had a proxy fight. They fired everybody on the board. They have a brand new board, and I don't know if you saw it, but this last quarter they announced record earnings. So within 6 months of acquiring the company, or 9 months, they turned the company around just by doing the things they told the board that they should be doing. So people don't listen. It's a bad event. Now, I've given bad examples in all of these, but you have to understand good things can cause companies to lose control as well. We talk about the dog catching the car. If you're a supplier or manufacturer or something and you get Walmart as a customer, people go, oh, great, I've got Walmart. But then you find out that the demands on Walmart are so onerous that you're not making any money on that account. And you haven't gone through the activity-based costing analysis to realize what a profitable customer is. And you can have a good event that actually drags your company down, or the lack of innovation, that that you're not innovating, or innovation that's so far ahead of the curve that there are no customers for it. You're solving a problem that doesn't exist today. So that sort of thing can bring a company down just as poorly as this, and there are indicators behind on those events as well. So as we go through this process and we decide, we go back to the quadrant, and you can see how it all flows from the across the difficult to the chronic up to the severe and the acute. You can see how all of this comes together and pretty much so explains the life cycle of a business in a crisis and how they're building. If you think back what I said about the difficult, it's the little things, and they built into the bigger things. And from the bigger things, they got to the out of control phase. And we've all seen this in our businesses at some point or another, an event that cascades. And just think, what would happen if somebody, somewhere in that bottom quadrant, pulled the leadership team together and said, we've got a problem that we need to fix, and the problem is not as simple as you might think. And the way that person does it is through looking at what an indicator is. So as we look at indicators, they're clues or cues that give you more information about business crisis, and it can be something you see, say, it can be something you feel, actually, that something just isn't right. And I've given some examples of what an indicator is. Customer service is handling more calls than usual regarding products to one single supplier. So, all of a sudden, customer service is getting this. Now, in this client I was talking about, they were getting those cues, but all they did is tell people, well, either ship it back to us or we'll cannibalize a part from a good product and we'll send it to you. And they said this is good customer service. Nobody ever went back and told procurement, hey, we're getting a lot of these coming back. So had they done that, just think it, had they done that, and as Barney Fife says, nip it in the bud, then they would not be able, they would have never gotten into the problem of having excess inventory where the bank wasn't lending and they'd be out of money. Another 6 days in a large facility. Firestorm had a client, a very, very large online retailer, and over Christmas time, their distribution centers swell from an average of 2,500 associates to 6,000 associates. Well, during this time, this past holiday season, if you remember, the Ferguson scenario event had happened. And so they started to see more sick days within some of their facilities, and their production wasn't what it was. And so they actually asked Firestorm to start doing some social media intelligence to try to figure out what's going on inside their facilities. You know, what are people saying? What are people feeling? And we found out that they had a problem, but we were able to tell them about this problem. But the indicator they had was that sick days came up. And when you have a part-time employee and they're only going to work for a couple months and they start calling in sick, that was an indicator that they recognized. The next one is a great one. Your largest customer calls you up and asks for your last 2 years of history. Now, I know in the accounting firm when everybody said, can you tell me what you billed me for the last couple of years for audit and tax services, I knew that was an indicator they're getting ready to shop. Well, that's what's happening too. This is an indicator that you could be losing your largest customer. And it could be because you have poor customer service. It could be because you haven't been paying the attention you should. It could be that the looky-loo came in and offered them a sweetheart deal that your pricing isn't effective. And then, you know, you have to be proactive, that pricing and value and service is all connected. But if somebody doesn't say in the billing department, hey, we just got a call from our largest customer and they've asked for this information, if they just keep that to themselves, then that's a crisis that could be heading out of control. You know, Firestorm does a number of data breach scenarios, and if your company hasn't gone through one, I highly recommend it. But the initial data breach scenario is the internet's spotty. Systems just seem sluggish, you know, and of course they go to IT, and IT just blames the carrier. It's, you know, it's the line, they're doing construction, or yeah, I've noticed it too, or, you know, we think we have this or that kind of problem. So as we go through this, we have a 7-stage plan that we can go through that will run somebody through this, and it's conduct a business risk audit, review it, develop a plan, learn from it, contain it, resolve it, and then do a hot wash. Now, I'm just going to spend a few moments on the first 3 steps. The business crisis audit is where you pull everybody together in a room and you say, what are the bad things that can happen? By everybody, I mean the CIO, CFO, CEO, mid-level management. You all sit around the table and you say, what are all the bad things that could happen to us? In the second phase, you review that and you actually try to quantify it. And in that phase, you actually have the CEO, CFO, CIO step out of the room to the extent you can. Because I find out that they usually underestimate the probability something will happen and overestimate their ability to handle it if it does. The mid-level people, we know, are the ones who actually resolve the crisis. So they're going to go through and measure that crisis. They're going to put dollar value to it. They're going to look at speed of impact. They're going to look at the severity and frequency of it happening. And they're actually going to use a mathematical formula that will help triage this. You can have a low dollar amount impact, but a bigger impact on the business and decide not to do anything about it. Target was a great example of that. Target knew they had a data breach problem, but they figured between insurance and other items, that the other mitigating factors, that it really wouldn't impact them that much. And in the end, they were right. It was about $158 million after insurance, and you know, their first quarter sales were in the billions. This was a nit. Now, to the reputation, it was terrible for the CEO. It cost them their job because they didn't have a plan to impact the reputational risk. They had the financial risk, they didn't have the reputational risk. Now we'll take the exact same scenario with Home Depot. They knew they had a problem. They knew that they could mitigate it. They also had a plan for the reputational risk. So again, they had a low dollar impact. They also managed the reputational risk. And from that, though, you develop a strategy. And by the third step, the strategy is to deal with that risk. It gets back to the predict, plan, perform. It gets back to those 5 blocks. It gets back to really drilling down, having that detailed plan with a message mapping. What are we going to tell our customers, our suppliers, our employees, our stakeholders, our bankers? What are we going to tell everybody about this? Internally, how are we going to communicate with our board? At what point does a data breach rise to the level that we have to let the board know? Well, if you're smart, you're going to ask your board ahead of time. But you have this very detailed plan. Now, what you find out is you'll make these detailed plans for the first 2 or 3 items that you've identified. And they may never occur, but when a crisis does occur, you have the plan, the methodology, and the team together that will deal with that risk and the protocols they're doing. So the last item on there, though, is to learn, and I want to spend a couple of minutes on that. And that the hot wash is the after-action report, and really is the most important critical piece of this. Because after this, you've got to learn from it. And I mentioned in the beginning that I had a tornado that got hit, and we did a hot wash afterward. And we had this great plan that we had two big plans. One is if it hit our data center, we would just take our backup tapes, go to our vendor that supplied us with our software, and we would plug our software in, and our vendor would step in and save the day for our ERP. And we'd also be able to ship from other facilities because, we were a big company. We had 32 distribution centers, and yes, this was a big one, but heck, we had plenty more. We're going to ship from York, Pennsylvania, or Cincinnati or wherever. Well, we found out was two things. One is we had customized our ERP so much that nobody could have run it. The tornado missed our data center by about 200 feet. Had it hit the data center and the warehouse, we would have been out of business. The other thing, and I've already alluded to this, is we didn't have a backup plan. So here you see the attributes of a hot wash: the review, obtain, note what's going on, and these are all the steps that you go through. And so after the event has happened, and after you've gone through this, going back and spending time identifying what worked and what didn't work, getting feedback and modifying your plan is vital to it. So that's an overview of this. And Jim, I'd ask you, well, what would the next steps be?
Well, first of all, I'd like to thank you for a Barney Fife reference, which I found exciting to hear. I don't think we've ever had that before. So you set a new record there, Jack. Great overview, and certainly gave everyone a path to addressing it and outlined how these functions, whether it's a formal internal audit department or just the need here is present. The question I'd ask everybody on our call today is, do you know what will happen tomorrow? And the key second question is, can you afford not to know? You have to be able to understand what the next crisis will be within your business, because that's the one where Jack gave the example. The data center was 200 feet away from where the tornado hit. If you lose the warehouse and the data center, you're out. That's what you would need to know. We'd be glad to work with you to help you align your plans to best practices, to create your own intelligence network, or to schedule some crisis coach training. If you'd like to have an evaluation of your plans, the cost of that's been underwritten by the Rochester Business Alliance or the Eastern Great Lakes Association of Contingency Planners, and we can look at your business continuity or other plans within your organization. Our thanks today to the Rochester Business Alliance and the Association of Contingency Planners for underwriting today's webinar series. Chip, any comments and reactions that you have today?
Well, Jim, thanks. As always, you and today Jack spark all kinds of thoughts in my mind, and one that came through is thinking about some of my experience with clients. One client that I had that I was called in because they had a horrible safety record. They'd lost their bonuses and wanted me to come in and fix things. And I talked to the CEO and said, well, what are you good at? And he said, crisis management. With a big smile on his face, he says, we manage at least a dozen crises a day. And then I walked through the plant, and of course what I found was that he didn't need to do that because all of his employees knew how to handle a crisis, but they'd never been asked to do it. And the counter to that was a chemical plant manager who ended up with the best facility in this large corporation, and the way he did it was he was out on the plant floor 50% of the time talking to his people. And every time he heard ideas or concerns or things like that, he put a team of people together to start working on it. And I think the contrast is amazing, that what Jack has given us today is a lot of things to think about, a process and an approach, as you from Firestorm always give us. But if you boil it down to simple terms, for me it's get out and listen to what your people are telling you, and that's going to get you a huge amount of information that you can actually work with. So thanks again.
Thanks, Chip, and thanks for the insights. And Jack, I think you did a great job of explaining those steps and the process that we have to go through. If you'd like to know more about this, you can contact us at firestorm.com or send us an email at webinars@firestorm.com or give us a call at 800-321-2219. We'll try to reach out to everyone today on the call to see if we can answer your questions. We didn't have enough time at the end of the webinar today to do that, so we'll reach back to each one of you individually. Thank you all. Have a great weekend. I'm glad that spring is here. I know that in Western New York, having lived there, that spring is something that you look forward to. We just need to get it there sooner instead of later. Thanks, everyone. Have a great day. Goodbye.